Everyone, welcome back, ROIC members. This is our ROIC only stream for Thursdays during the week. I will keep this one a little bit shorter because I literally am flying and taking off in 2 hours. So I have to finish packing and then get an Uber to the airport. So we'll keep this one really short, especially since we were just live last night. And today would just be a continuation of what we saw yesterday. We're seeing quite an aggressive continuation of rotating from growth to value. And if we were a macro community where, we were a little bit more like Tom Lee, who's always on CNBC, or if we were more like Real Vision, which I don't think they actually do real investment research, it's more like macro content. Maybe we would have more aggressively rotated from growth to value, or at least growth to cyclicals. But, at the end of the day, what gives us confidence and what, my bread and butter is investing in specific companies. So, we did make a concerted effort on the big board. Let's just show the big board to rotate more into kind of the non-growthy names. And, as the sell-off has been going on, we've actually increased that portion of the portfolio. But, a lot of, I would say a lot of 10% of our portfolio is compounders. And, Uber is a special situation, and so is Altimmune. And, and then value has been growing. The thing is with value and cyclicals is, I think the unfortunate thing is my time, as you know, we're trying to build this thing one piece at a time. Our ability to look at more stocks was a little bit constrained, kind of even as we foresaw the interest rate risk. But even that said, it's kind of hard for me to let go of some of the companies I really believe in. I don't know why this is loading. This is always doing that. So hold on, let me try to fix that. Loading. Yeah, sometimes the Google Sheet integration just breaks down. But if I refresh this, I'm sure it'll go. But you kind of look at the stocks that we're really in. A lot of them are just ones that I believe in for the long haul. And yeah, again, we're gonna have to make this site faster. Managed WordPress hosting is going to cost me like $3,000 to $4,000 a month. So I'm reeling from that quote this week. So 10%, you're right, is compounders. We really love Zillow, right? We want to play that for the real estate, allocation, but still such a great business at a reasonable price. Growing at 50% a year and high teens times forward gross profit multiple. Everyone knows the deal with Peloton. Not like I'm just doubling. And we sold off quite a bit of Peloton when it was above 150. If you actually watch the trades, we sold out quite a bit of Peloton. It went down to, I believe, below 5% of the portfolio, and now it's like 12%. So we've been playing the Peloton game. If they're going to give us a discount on one of our favorite stocks for a PR hit, we're going to take that all day. Vizio is one of those things, right? It was kind of let's scrape some profits while we can. Don't love the business. So that was one that was easy to trim down this week to free up some liquidity. Futu and Up FinTech, which is Tiger. Futu we're actually profitable on. And these two are just one of those ones where we're going to hold them. I mean, unfortunately, the foreign issuers only report 6 months, every 6 months. So we're just going to have to wait a little bit longer for them to report 100% growth, more 100% growth, more 100% growth. And at a certain point, the fundamentals will win out. PushPay is like dirt cheap for the growth stock it is, and it's just one of those ones that I would like to take a flyer on. Cornerstone Building, that is a concerted effort from us to get into cyclical building products, the value stock that we think is going to double. AT&T, that's something I really do believe in, and it does anchor the portfolio a bit in terms of portfolio construction. But I will look to AT&T as a kind of a liquidity pool. If we find something like a double that we really like, double, triple, or quadruple that we just absolutely love, like I'll think of that as the liquidity pool, because we do bend towards a 10 to 20 year view, right? So CVS, love CVS. I think this is an over $100 stock. And again, so we've realized about half of the gains to our target price. And so, we'll look to trim as it gets closer to 100, but it's also quite nice to be levered towards retail, levered towards, the reopening vaccine distribution. It's just a nice thing to anchor a portfolio with a 5% position. IEA, look, this one's really undervalued, but it's also kind of like, it's never going to be a core position. So I would look to trim this one if I needed to. Uber, love Uber, right? I think Uber is an $85 stock. Altimmune, that one's one of the ones that we buried in the backyard. I don't even look at this one. It's either going to print really great. Altimmune's really either going to pass trials and just skyrocket, or it's not. So you got to look at Altimmune as kind of a call option. That looks really a very underpriced call option. And in a similar sense, I think Futu and Tiger, and to a greater extent Tiger, that's a buried in the backyard type of thing. And with Bitcoin and Ethereum, these two are buried in the backyard, but we'll trim it if we start hitting like 150K Bitcoin. I don't think the bull run's over. I've lived through multiple bull and bear runs, and this is much more stable, less leverage, less mania in this bull run than before. And this will whipsaw back and forth. And we're still 7.8% cash. So that will allow our portfolio to outperform in the down draws against an ARK Invest, right? So hopefully, what my bet with this whole thing is my style and philosophy investing on top of the skills that I have and experience. There's a place in the market for it. And I know there's a place in the market for it because all of my former colleagues, some of them are better analysts than me, to be frank, or better private equity MDs than I am. But they really want this product. They want a aggressive compounding portfolio, but with the temperance of a value investor. So, I think Cathie Wood delivered product to the market that they really wanted. Innovation, compounding. I want the highest amount of growth. But some people don't want to go all the way there. So that's why we've been kind of grinding up and being relatively flat and stable, which I mean, unless you were willing to go all in and really rejigger your philosophy on a macro point of view to what I would consider buying crappy businesses, right? So you're talking about oil and gas businesses. You're talking about banks. Like long term, I think banks are getting hemmed in by fintech. And you're talking about buying like really crappy cyclical auto businesses. Like that's just not my style. And because my view is on a 10-year basis. So will I pick up pennies? Sure. Like if the pennies are big enough, I will pick it up. But I don't love trading in and out of crappy businesses. So they will make their way into the portfolio because I am trained as a value investor. Like IEA is not a great business, but it's super darn cheap. But some of these cyclical businesses are not that cheap, right? You look at cruise lines, you look at airlines, they're really expensive, even though they're outperforming now, right? The cyclical reopening trades, they're outperforming now, but you look at the valuations, and if those do sell off later, I don't have any confidence in it because they're basically trading on, you have to look 2 years out, and they're trading on historical multiples based on like 2023 recovered earnings, except today, right? So one can make the argument that despite their overperformance, they're still just kind of overvalued. I think as an investor, generally, we're all humans and we just have to, right? We're social animals, and the midbrain tends to run with the herd because that's how we've created value in the world, is working together. But when the market is making big moves one way or the other, like the right answer probably is either do nothing and get the emotions out of it, or do the opposite of what the herd's doing, right? So as you can tell, we double down on Peloton. We're doubling down. Like if Uber gets even cheaper, I'll probably double down on Uber. you're getting really great growth companies, and as long as they have a fundamental floor to them, which I provided the stock calculator on the website where you all can kind of do it yourself, and it simplifies a DCF for you. As long as there's fundamental floors on the DCF valuation, like we can buy undervalued stock all day. And you all are actually in a position that I'm not in on the big board, right? You all are earning and hopefully having your day jobs, which is, for most people, the best way to wealth is earning it, and then investing it. But you have the ability to like keep making money and then earn your way out of any losses. I also wanted to just calm everybody down by saying, like, guys, one of the, if you had bought Amazon anytime, right? It's up 1,600%. But I just want to show you, right? If you had bought at the top of the bubble, but you really believed in the company, you're buying at like 90, maybe $100 a share, and you would have lost 90% of your portfolio. But as long as you believed in the company, and again, I actually think that we would have, like, our style would have avoided Amazon in the bubble because we are looking at valuations, right? Amazon.com got caught up in the .com bubble. So anything with a .com got traded up to oblivion or to, the Icarus level. So I think we would have avoided that. But then right now what we're doing is, it's coming down to 60. We're probably nibbling at Amazon. Maybe it comes down even more. You just keep buying. And again, I can't really reflect that on the big board because, the big board is just a static number that we're using, right? So I have to kind of rejigger it. So it's a little bit harder for me. But for you, it's a lot easier, right? You just keep buying as long as you believe in it and you believe in the valuation. So look, even if you had bought in 2004 and you'd bought at $55 and, there was a sell-off, you would have lost 30% of your portfolio at one point, right? A third of your portfolio. I don't know how much you all are down. Some of you newer investors are down. But look, this is the market. If you want to sleep well at night, or if you don't want volatility, go buy a bond. The more risk in life you take, the higher return you go for in life, the higher risk, right? And that goes with anything. There's no free lunch in life. So you can't get like the Shopify returns without risking a bunch of stuff. So comes with the territory. This is the market. Welcome. This won't be your last sell-off. But I'm just saying, like, even if you had bought in 2008, right? And you had the massive sell-off, right? You would have lost half your money in Amazon. Even if you had bought in December 2013 at $400 a share, you would have lost a third, maybe 20% of your money in Amazon. Even if you had bought Amazon at $640, you would have lost, what is that? At that point, 14 on 6. So, you would have lost 20%, right? One of the best investments ever in our lifetime would show huge drawdowns, right? 2000 goes down to, in 2018, there was not even a real recession there, right? You bought at 2000 and it goes down to 1300. You would have lost 40% of your money or something like that, 30, 40% of your money, right? Along the way up. But the only difference between this and a Nikola, right? I'm taking the exact opposites, is fundamentals matter. And this is, I didn't get too many comments, but I did get the occasional comment when I was talking about Nikola, right? Very early on. And it was like, fundamentals don't matter anymore. Okay. I was wrong in the short term, but in the long term, I'm right, right? Or if you're right about the fundamentals, you're right. They matter. So there's a spectrum. One is Amazon. One is Nikola. One is an amazing monopolistic business that creates value for shareholders with a high incremental ROIC, ROIC, return on invested capital. And the other, at a good valuation. And the other is crappy business, no business at all, really crappy valuation where you have to believe a lot of things in faith. Tesla is a great company. hard valuation. So it makes it kind of somewhere in the middle. Everything else is kind of in the middle, right? So if you really want to sleep well at night, first of all, you just got to get used to the emotions. Like, just don't be phased, right? For some of us that have been in the market for a while, like, this is nothing. I lost 95% and I lost 90% in crypto. Like, nothing hurts me anymore, right? And so, yeah, so if you're going to buy Bitcoin, I'm telling you, like, it can go up to 150,000 and then it can crash to like 40,000 and you're going to like, we're all going to freak out a bit. And I think it's fun, right? It's fun. But, yeah. So, okay. Sebastian's saying no free lunch is a myth. 2 years ago, someone sponsored my lunch. Well, there is something in return, or the person, maybe, there is charity, right? But in terms of investing, there's no free lunch. Giovanni, you're saying this hurts though. It does hurt. It does hurt. But what are you in the market for, right? Are you in the market for maximum returns? Or are you in the market are you investing for pain avoidance? Because if you're in the market for pain avoidance, just go put it in a certificate of deposit and earn like a 1% yield on it, right? And you won't ever have to worry about it. And also, I will give you another thing is, the market is actually, real estate may seem safer, but it's actually not, because there's a lot of leverage into it. And for those of us that have lived through and invested through the great financial crisis, it's just the fact that we have a Mr. Market quoting at us every single day. And a bunch of people, I guess the term now is paper hands, but right, Mr. Market is very fickle and very scared and skittish and whatever. And in the real estate market, it does trade every day, but you just don't look at Zillow every day, right? Nobody's quoting you something every single day on your house. Yeah, and then this is like why we're here, right? Why we do content, right? Like, this is nothing, guys. This is nothing. So when we're investing in like Futu, and remember, look at the pain we felt with Tiger and Futu. Futu's now up. But Futu is like you just have to believe that it's a good company and good valuation, and you just have to wait long enough, right? We are champs with this stock, right? We went from like here to here, we got here to here to here to here. Like, I don't really care. You're either right in the 5 to 10 year frame, or you're wrong, right? Kathy Wood is either going to be right about genomics in 5 to 10 years, or she's wrong. So that's that. I just say, like, look, how much are you down? Like, I think when in doubt, zoom out, right? And there's two scenarios here. How much are you down? Let's say you have 100,000 invested and you're down like 20%. So that's 20 grand. I'm talking to the US investors here. So like, I know there's cost differences. So just maybe like translate that to European or whatever. Let's say, and then you make like what? Like, even if you make 60 grand a year or 70 grand a year, right? You're down like 20%. Like, you don't need to sell. No one is holding a gun to your head to sell the companies that you like, right? So you don't need to sell. So there's really no loss until you sell, right? And all the while, like, go read a book, go like increase your earnings potential, and like, just forget about it. Just forget about it, right? Yeah, and it'll probably go, like, if you're investing with me, like, I'm betting that a lot of these companies will go up over a 5-year frame. So like, doubling your money in 3 to 5 years, pretty good, right? But quarter to quarter, like, I really don't care. And so like, I can, like, even if Peloton like says something crazy today or whatever, like, I'll have to, I'm sweating about that a little bit, but it's like, I'll be on a plane. It's like, it's not the end of the world. And then on the other end, like, you're down like 15, 20%. Does, how much does that actually hurt? Well, does it hurt as much? Like, put it into context of like your life too, right? It's like, what's more devastating than 20% losses or 40, 50% losses is losing your job, getting a demotion, right? That stuff on an NPV basis will hurt you way more. So first of all, let's like frame it, right? The market may seem scary, but like in the grand scheme of your life, like, it's actually below like your career, right? Your career, your family life, right? That stuff is way more important. So let's just like frame our content. should come after all that stuff. Family, friends, mental health, physical health, and career. That's all way more important for most people, unless you're like a bit like we do have some really well-off folks that are like they made like $4 million off Bitcoin but they have low earnings. In that sense, if you're one of those people, or you're like you're like a trust fund person, or like you live off of your assets, yeah, like investing is more important than a career, because you don't have a career, you have investments. But just framing for most of us. Secondly, I would just say if you are down more than 25%, I mean, or if you're down like 40, 50%, that means that you need to take this as a lesson. Because I mean, it's kind of hard, right? A lot of this is stylistic. But if I just go here, right? It probably means you invested like Kathy, right? So you went from, let's actually just look at nominal numbers. So like ARK Invest. So you went from 156 to 108, right? So you're down probably 30%-ish, right? 33, maybe max 40%. That means that you were investing too aggressively. And I mean, this is why I'm here for everyone, right? This is the content. This is me saying Kathy misses stuff. Or like a lot of these people, they miss stuff, right? People are generally very, I'm a very like moderate person, and I can see both sides of the equation, right? You get these hyper value investors, and then they all like circle jerk around here, and like they're on their podium. And then on the other hand, you have these growth people that are like anti them, right? It's like the two-party system. Like, I don't know. It's like politics is always two-party system, investing two-party system. We're trying to sit more on the growth side for sure. But with that's the whole thing is I've struck out 80% of the ARK holdings. They're not on the ROIC big board, right? So also it hurts because it seems like some of you are using out of the money options. Well, this is why I think of options as very specific ways to take a view for experts or someone who wants to take some gambling bets, right? There's nothing wrong with that. But you just have to you have to go into the expectation if 100% of your portfolio is buying and selling call and put options that expire relatively soon, then you're entering the arena of going, like the Kentucky Derby was just last week, right? It's like betting on squares for horses. Like you don't go into those events, or you don't go to Vegas thinking like I'm going to I'm going to come out and be a millionaire. Like, I don't know. If you do, then you haven't seen the statistics, right? So just take it as a lesson, right? This is the beauty of this is hopefully we all live long lives together, and hopefully we're all investing together. This is the whole point. I would not do this if I didn't think this. I wouldn't be building this in a long-term fashion. Look, if you're in the United States, chances are if you're in this community and you're relatively savvy, you're on Discord and you know how to use a computer, you probably make 60, 70K, right? I believe in you. And if you don't, I believe in you. Go to like Khan Academy, or go like learn a trade, like an internet trade or something. Like you can go make that. I mean, maybe not immediately, just go make that. And what hurts is maybe you're losing like 10, 20K. And when you're like in your daily life and that's like 100% of your savings and you went too all in, it's like, that's a lot of burritos. That's like your rent. Where are you going to get your rent? Well, as long as you're employed and you focus on the more important thing, which is your career, right? You can earn it. You can earn it back. 20K, like you learned a lesson. That was tuition right there. Don't go all in on out of the money call options that expire like in 4 weeks, right? That's the lesson you learn. And so we all learn the lesson. Either you learn it from someone else and you actually like take it to heart, or you learn it the hard way. And I'm going to say I'm actually someone who learned it the hard way on small dollars. I was in high school trading options, right? Because I love this stuff. And I like my dream was pre 2008 and pre like Dodd-Frank and all that, or I think it was Dodd-Frank. I was like, I want to be a prop trader. That's what I wanted to be when I was like in high school. Um, and then, realized that was a dying field. Plus, well, fundamentals are more, you learn these things over time. And so you can either listen to me say it or you can learn it the hard way. The hard lessons stick with you longer or stick with you more innately because you remember those feelings. So in a similar sense, like the real estate folks who are just now pan finance, like meet Kevin and like Graham Stephan, they've learned a lesson in real estate being old. I think they're like around my age-ish, right? And they saw the over leveraging of real estate. There were a lot of paper real estate millionaires, especially where we come from. Me, Kevin, Graham, we're all Southern Californians, which is kind of funny. The over leveraging of real estate, and then everyone, like people lost like $20 million portfolios. So they learned that lesson. They took it to heart because they saw it, right? And so what you're seeing here is a pullback in overextended growth stocks, which on a macro basis will pull down some of our growth stocks. Make no mistake, right? When the market is up or down or selling across the board and it pulls these macro movements together, but just remember, the reason why we're in these companies is because of their revenues and their profits. We don't care about the name. We care about the business model, the revenues and profits, and the valuation, and what price we can buy those revenues and profits. Look, I'm going to leave you with this. Conceptually, if we can grow ROIC to be like a big, huge thing, and again, I'm not me, Kevin, I'm not Graham Stephan. So these guys have bigger platforms and I don't even focus on the platform. I focus on you all, right? Like that's why I haven't until the video people get here, I can't really even do real public videos anymore. I'm just like focused on ROIC. Even if it means we're going to pause growth. But even if we could grow our community globally and get through all the legal, hundreds of thousands of legal bills, and we could raise a fund, right? At a certain price, some of these companies, we would just take it private, right? If you grew AUM to like multiple billions of dollars and something's trading for like, I don't know, like 8 times gross profit and growing like crazy, and the market, Mr. Drunk market is giving us this price, a private equity fund is going to swoop in and go take them private. But I will say that's kind of tough. The reason, and I know the question is going to be, why doesn't it happen more? Well, it's because public company CEOs and CFOs, they want to keep their job because if they get taken private, a lot of cuts are going to happen and they're probably going to lose their job, right? So they do poison pills and like they don't agree to, I think and also when the stock's down, management and the board doesn't want to sell to privates because they think it's undervalued too. So they will rather like opt to buy back stock or just do nothing. So, yeah, so that's that. So, yeah, so that's, I know this was more of a couch session today. A lot of the analysis is in Morning Sense today. We rolled out the mini board, so we're going to keep that. We started tracking it last week. Everyone needs to thank Danica in the Discord. And this is going to be a rolling kind of like quick rating system for us. We should probably put in like the actual thing here, but it's like kind of emojis. It's like the puke face is like, doesn't look good at all. I would sell it if I were in it. The uninteresting face is just like, it doesn't get me out of bed. The monocle face is like, it's interesting. And then the money face is, wow, this is super interesting. We need to prioritize this. Yeah. So we're going to keep this up, and it's a lot of work for Danica. Like Danica's like crushing it. She's it's a lot of work here. Right. So, definitely give her some thanks. And okay, so this is 30 minutes, run on 30 minutes. I appreciate you all. I know this is not like, we didn't get into the nitty gritty of like looking into stocks. I think we'll leave the week here. I think more importantly, when in doubt, zoom out. When in doubt, look at the companies and the ones that you want to like. this is probably a good time to learn which ones you really don't want to sell, right? When the market sells off, like bloodbath across the board, blah, 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 right? Do you really want to sell? Do you really not like a company, right? So the big board, I just called out in the beginning of this rewind, I just called out a few on the big board where it's like, I don't love the businesses. Like they're in there for a reason, for like a portfolio management reason, or like IEA is just so cheap. Like I don't love the business, but it's just so cheap that it's kind of like bouncing along its mattress. What I say, the closer you are to your foam mattress, like the more springboard you have on it. Plus you get some infrastructure play. I think it's just under the radar. But I don't love the business, right? Vizio, I don't love the business, which is why we took some out. We cut some out. So just now's the time to take stock, calm down, walk away from the screen. I know we're all like, especially me, I have 3 screens. Like, I've gained a lot of weight being stuck to the desk and doing like 2 jobs and everything. But I think now's the time to just like go outside, take a walk, understand priorities in life, right? And investing for most of us comes below career, family, and stuff like that. I think it's really hard in the context. So like if someone tweets something mean to me, like, oh man, I feel like it's the most important thing in my life. Or, or like if you're on a subreddit, you get all these like people arguing like really vehemently. And and like in the moment, it seems like the most important thing. Or even like, road rage, right? Your adrenaline's up, you're driving, someone cuts you off, and people like legitimately kill each other over road rage. But like, it's because we're humans and it's like the flight or fight like reaction. And that's what you get with the markets, right? You get this crazy, lots of numbers flying at you, lots of charts, everything's selling off. It like makes you want to do something. But remember, like when emotions are high, the right answer is usually step away and get the emotions out of it. And look at what you own. Like what farms do you own? If this was real estate, if we had $100 commissions on trades, people would be a lot calmer because it'd be a lot more painful to buy or sell, right? They would be like, okay, if I'm buying this, I'm gonna have to hold this. I'm gonna buy in bigger slugs and I have to hold this for a long time. So that's the reason why you don't get panics in the real estate market, because in order to sell your real estate, like you need to pay 6% commission. You need to go through like a sale process, hire a broker. It takes like 3 months, 2 months, like all that stuff, right? Emotions are higher when things are much more like liquid, right? And you get Mr. Market quoting at you every single day. So I would just say for most of us, let's just like enjoy your Thursday and Friday, enjoy your weekend, and I got to go catch a flight. So until next time, happy investing. You know where to find me. I read almost almost all of the things that fly into me. It's just really hard to respond. So I'm really sorry if it's a learning curve for me, but sorry if I can't respond to everybody all the time. So appreciate you being here. Thanks for being a member and for the support. ROIC for life. Love you all. Happy weekend. Bye.